All right, let's get right into it. What if I told you that one country's debt problem could actually be the trigger for the next global financial crisis?
Seriously, what if a single surprise move by just one country could basically vaporize trillions of dollars overnight? Sounds like a movie plot, right? Well, it's not. This actually happened.
Back in 2024, a teeny-tiny interest rate hike in Japan set off this massive global liquidation event. People called it a financial Thanos finger snap. And that little tremor, it exposed just how deeply and how fragilely Japan's economy is connected to, well, everything. And it's all because of this thing called the yen carry trade.
So what is the yen carry trade? For decades, it's been like the ultimate financial hack. You borrow Japanese yen where interest rates are basically zero, and then you take that money and invest it anywhere else in the world where you can get a higher return. It's pretty much been free money, and it's been fueling markets all over the place, from US tech stocks all the way to Bitcoin. And the scale of this thing? It's just staggering. Now, nobody knows the exact number, but one estimate from Deutsche Bank puts it at around $20 trillion. This isn't just some niche trading strategy, you guys. This is a foundational pillar of the entire global financial system. But here's the thing. That shock we saw last year, that was just a tremor, a warning shot. Now, we're starting to see much deeper cracks forming, and they're in Japan's own backyard. The problem is moving beyond a simple policy surprise and into something much, much scarier, a full-blown crisis brewing in their own government bond market.
Okay, so let's dig into that, because this is really the heart of the issue. We're talking about Japan's bond market, and it's starting to crack.
Okay, get a load of this number. 263%. That is Japan's debt compared to its entire economic output. It is, by far, the highest of any developed country on the planet. To put that into perspective, their government is spending more than a fifth of its entire budget just on interest payments. Insane.
So you have to ask, right? Who on earth is buying all this debt? Well, here's the crazy part. The biggest buyer is the Bank of Japan itself. Yep, the central bank has basically been printing money out of thin air to buy its own government's debt. They now own more than half of the entire market. But that's where the story takes a turn. The usual customers for these bonds, they're backing away. The Bank of Japan is trying to slow down its buying. Pension funds aren't as interested anymore, and what's left is a market getting dangerously thin and volatile. I mean, a recent bond auction had the weakest demand they've seen since 1987. That's a huge red flag.
And all of this has put the Bank of Japan in what you could call an impossible trap. It's a classic case of something called fiscal dominance.
Think of it like this. It's a doom loop. Step 1, the government's debt is absolutely massive. So, step 2, the central bank has to keep interest rates super low, otherwise the government can't afford its interest payments and goes bankrupt. But step 3, those low rates make the currency, the yen, super weak. And here's the kicker, step 4, a weak yen means they're importing inflation, which forces the central bank to, what? Raise rates? You see the problem? They're completely trapped.
There's this fantastic analogy from one analyst that just hits the nail on the head. They said a rate hike is normally a painful but necessary surgery. For Japan, it's a death sentence. They literally cannot raise rates to fight inflation without bankrupting the country. They are stuck between a rock and a very, very hard place.
Okay, so you might be thinking, this is all very interesting, but it's happening in Japan. Why should I care? Well, here's why.
Because Japan isn't just any country. They are the world's single largest foreign holder of U.S. government debt. We're talking over $1 trillion in US Treasuries. For decades, they've been the buyer of last resort, helping to keep our interest rates low. But now, with their own house on fire, what are they starting to do? They're starting to sell.
Now, to be fair, experts are totally split on this. You've got some, like the firm State Street, who see this as just a temporary technical hiccup, a simple supply and demand thing that'll sort itself out. But then you have others, like analyst Weston Nakamura, who sees something much more serious. He calls it JGB vigilantes, punishing the government, a fundamental loss of confidence. They see Japan as the canary in the coal mine for the entire global financial system.
So, with all this chaos in the traditional financial world, where does something like Bitcoin fit into the picture?
This is super interesting. During that big liquidity crunch in 2024, Bitcoin tanked right along with everything else, like you'd expect. But lately, something weird has been happening. Bitcoin's price has started moving in lockstep with rising Japanese government bond yields.
And remember, rising yields are a big flashing warning sign of instability. It means investors are demanding a higher payout for what they now see as risky government debt.
So what does this mean? Are we starting to see the market de-risk from government debt? Are investors finally looking for a real safe haven, an escape hatch into harder assets like Bitcoin? It's a huge question.
So look, whether this is just a temporary glitch or the beginning of a massive, permanent shift, one thing is clear. Japan is sending a huge signal to the rest of the world. The only question is anyone listening? Before you go, if you enjoyed this, you should really check out the full conversation on the What Bitcoin Taught Me podcast. And hey, while you're at it, remember to follow, like, and share. You can find us pretty much everywhere on Twitter/X, Nostra, Blue Sky, Threads, Instagram, Facebook, LinkedIn, Spotify, and now right here on YouTube. Thanks for tuning in.